In every financial crisis, there is a familiar pattern. Markets swing, headlines panic, and ordinary people brace for impact. Portfolios evaporate, savings shrink, and retirement plans are rewritten overnight. But while millions watch their futures wobble on a screen, a smaller group stands almost untouched. They do not rush to sell, they do not fear collapsing indexes, and they never wonder if they will have enough. When the dust settles, they are the ones who emerge with more assets, more influence, more distance between themselves and everyone else. This imbalance is not accidental. It is the result of a system that has been built, refined, and defended for centuries long before the first IPO, long before modern banking, even long before the concept of a middle class existed. Markets may rise and fall, but the mechanisms that protect the wealthy stay remarkably stable, and every crisis, no matter how destructive, tends to strengthen them further. To understand why market chaos routinely harms the many but enriches the few, we need to look past the daily noise and trace the origins of how capital moves, how risk is distributed, and who holds the levers when pressure builds. Crashes do not create inequality, they expose it. In moments of panic, the structure of modern finance becomes visible, revealing who absorbs the shock and who is shielded from it. This is the story of how the ultra-rich learn to survive turbulence, not through luck or prediction, but through architecture. A long lineage of decisions, some private, some political, some openly debated, and others deliberately hidden, shaped the rules of survival. And once you follow that lineage back to its origins, a clear truth emerges. Market chaos does not level the playing field. It reinforces the one that already exists. If you want to understand why the wealthiest survive every financial storm, you have to begin long before the modern stock market existed. Not in Manhattan or London, but in the early markets of Europe, where the idea of financial protection first took shape. Because the truth is simple, the ultra-rich do not survive chaos by reacting to it. They survive because centuries of history have positioned them above the point where most damage occurs. In the early modern world, wealth was tied to physical assets, land, gold, livestock, and crops. These were tangible but fragile. A bad harvest could eliminate a farmer's fortune. A fire could wipe out a merchant's entire inventory. Disaster was local and unavoidable. Yet even then, a pattern was emerging. Those closest to political power suffered the least. When catastrophe struck, rulers did not distribute losses equally. Tax burdens fell downward. Relief, when offered, flowed upward. And the people who financed governments were always treated differently from the people who paid them. The earliest bondholders, the merchants and aristocrats who loaned money to kings, were the first group in history to consistently profit from instability. Their investments were not collateralized by farms or ships. They were secured by something far stronger: the future taxes of the entire population. When a king borrowed money, he pledged the labor of millions who had no say in the agreement. War, rebellion, or famine might disrupt commerce, but the monarch's promise to repay his creditors stood above all other obligations. Royal debt became a shield, and those who held it became the earliest version of the financially untouchable. By the 17th century, this arrangement had matured into something far more structured. European powers fought increasingly expensive wars, each demanding more resources than the royal treasury could supply. England's struggle against France in the late 1600s created a problem that changed the world. The monarchy was running out of gold, but the war could not stop. In desperation, the crown turned to wealthy merchants. In exchange for financing the state, they were offered a permanent stream of interest, backed not by land or treasure, but by the king's taxation authority. This was the birth of a new kind of financial relationship, one where creditors were not merely investors, but stakeholders in the survival of the government itself. To administer this arrangement, the Bank of England was established in 1694. It was not just a bank, it was a mechanism that formalized the power of wealthy lenders. For the first time, the richest members of society had a direct institutional claim on the future revenue of the state. And the state, in turn, relied on their capital to function. This structure laid the foundation for how the modern ultra-rich would operate centuries later. They did not just own assets, they owned obligations. They held instruments that governments were legally, politically, and economically compelled to honor. While ordinary citizens faced the full force of crises, lost farms, shuttered shops, rising taxes, the wealthy held claims that were insulated from destruction. Their fortunes were tied not to the success of a harvest or a voyage, but to the continuity of government itself. As the idea of public debt spread across Europe, the arrangement became universal. France adopted it. The Netherlands refined it. And when the United States emerged as a new nation, it embraced the model wholeheartedly. Alexander Hamilton understood the power of public credit better than any of his peers. He argued that the strength of the nation depended on its willingness to honor its debts to wealthy creditors. His assumption of state debts after the American Revolution ensured that the new government was firmly tied to the interests of the nation's richest financiers. The pattern was clear. The state needed capital, and the wealthy needed security. And every time a crisis threatened that relationship, governments made decisions that protected their creditors. Without the capital of the wealthy, governments could not wage war, build infrastructure, or maintain stability. So in every major recession, collapse, or currency crisis, leaders found ways to preserve the system that kept wealthy lenders confident. This is where the modern architecture of financial survival truly began. The wealthy learned, generation by generation, that the safest place to store money was not in land or goods, but in the liabilities of the state. When a monarchy fell, the next regime still recognized the bonds. When inflation rose, interest rates were adjusted. When wars drained treasuries, taxes were increased to ensure payments continued. Losses were distributed across the population. Gains accumulated at the top. By the 19th century, this model evolved again. The rise of international finance meant that wealthy families were no longer just creditors to a single nation. They were creditors to many. The Rothschilds financed governments across Europe. J.P. Morgan stabilized the U.S. Treasury. These financiers didn't wait for crises. They often stepped into them deliberately, acquiring distressed assets and emerging even more powerful. Crucially, this is also when financial knowledge became a form of insulation. Understanding risk, leverage, and liquidity was not common. Financial literacy did not exist for most of the population, but for the wealthy, it was taught, inherited, and guarded. Crashes that devastated small investors were navigable for those who understood how markets functioned beneath the surface. By the early 20th century, the divide was unmistakable. Ordinary people participated in the economy. The wealthy shaped it. Ordinary people bore the weight of downturns. The wealthy positioned themselves to acquire what collapsed. And this brings us to the core truth that begins in this early history and extends into the present. The ultra-rich survive market chaos because their wealth was never designed to operate at the same level as everyone else's. Their assets, their knowledge, their connections, and their legal structures all emerged from centuries of alignment between capital and power. They were never simply participating in the market, they were intertwined with the very institutions that governed it. The origins of their invulnerability lie here, in the early architecture of public debt and political dependency. Long before stocks, derivatives, hedge funds, or global banking, the wealthy had already secured a position above the point where financial storms do the most damage. Their survival is not a mystery of luck or timing. It is the logical outcome of a system built layer by layer, crisis by crisis, over hundreds of years. By the early 20th century, the foundations of financial protection built over centuries were firmly in place. The next stage of evolution came from something simple but transformative. Markets expanded faster than governments could regulate them, and capital began moving faster than ordinary people could understand it. In this widening gap, the modern ultra-rich found their greatest advantage. The Industrial Revolution created wealth on a scale Europe had never seen. Railroads, steel mills, shipyards, and oil refineries turned individual fortunes into economic empires. But more important than the industries themselves were the financial structures built around them. As corporations grew, they needed capital far beyond what a single bank or family could provide. The solution was the public market. Shares could be sold to thousands of investors, creating permanent pools of capital. Yet control rarely shifted downward. A handful of families, trusts, and holding companies maintained authority over companies financed by the savings of millions. This divide between ownership and control became the defining feature of corporate capitalism. It meant that during downturns, the wealthy did not lose influence. Their voting power, board seats, and interlocking directorships insulated them from the consequences of market swings. Ordinary shareholders worried about prices. Elite shareholders shaped the rules behind them. Then came the creation of the Federal Reserve in 1913. It was a turning point not just in American finance, but in the fortunes of the ultra-rich. For the first time, the financial elite had a central institution designed to stabilize the banking system, a system they dominated. Crises that once wiped out lenders and speculators could now be softened, managed, or prevented. Liquidity could be created in moments. Interest rates could be adjusted to preserve the system's core. It was not corruption, it was design. The Great Depression revealed the full implications of this arrangement. Millions lost their jobs, homes, and savings. Yet amid the devastation, powerful families and institutions expanded their holdings. Banks consolidated. Industrial giants absorbed weakened competitors. Investors with cash or access to cash bought real estate, factories, and entire companies at prices that would never be seen again. The lesson was unmistakable. Crises did not level the playing field. They magnified the distance between those who had liquidity and those who did not. The wealthy understood this. They became students of timing, leverage, and patience. They kept reserves when others did not. They held diversified portfolios long before diversification became a mass market concept. And they held relationships with bankers, politicians, and regulators that became as valuable as money itself. After World War II, this trend accelerated. America's economic boom created a large middle class, but the architecture of financial protection remained exclusive. Pension funds, insurance pools, endowments, and foundations expanded the ability of the wealthy to direct enormous streams of passive income. These pools did not panic in downturns. They rebalanced. They bought more. They acted with the long horizon of institutions, not the short horizon of individuals. Meanwhile, global finance entered a new era. International monetary agreements, foreign exchange markets, and cross-border capital flows created a world where wealth could move instantly, while ordinary labor remained rooted in place. The ultra-rich were no longer just insulated from domestic shocks. They were insulated from national boundaries. A crisis in one region could be offset with gains in another. A currency collapse in one country could be hedged through derivatives or repositioned into a safer market. By the 1970s, the deregulation wave made this global flexibility even more powerful. Complex financial instruments appeared: options, futures, swaps, tools that could hedge, amplify, or neutralize risk in ways unimaginable a generation earlier. These tools were not created for everyday people. They were engineered for institutions, funds, and individuals with enough wealth to pay for the expertise required to use them. The ultra-rich acquired a new kind of protection, the ability to shape their risk exposure with precision. At the same time, tax codes around the world began rewarding capital over labor. Capital gains rates fell, estate tax thresholds rose, trust structures expanded. The wealthy could now shield assets across generations, passing wealth through legal channels designed to preserve it indefinitely. Losses could be written off. Gains could be deferred. Risk could be transformed into advantage. The modern financial system had reached its mature form, and in this form, the ultra-rich did not merely survive market chaos, they prepared for it. They expected recessions. They modeled collapses. Their advisors built strategies around downturns, seeking the moment when fear would drive prices below intrinsic value. The playbook was simple: hold cash, deploy it when others panic, acquire assets cheaply, and wait for recovery. History rewarded this strategy every time. When the dot-com bubble burst, elite investors were already positioned to buy technology giants at prices that would later look impossible. When the 2008 financial crisis struck, institutions and wealthy families acquired distressed real estate, banks, and securities that multiplied in value within a decade. None of this was luck. It was structure. This rise was not the story of individuals who outsmarted the market. It was the story of a class whose position in the financial hierarchy allowed them to act from strength while everyone else acted from vulnerability. By the end of the 20th century, the ultra-rich were no longer simply beneficiaries of a favorable system. They were deeply embedded in its architecture. They chaired central bank committees, directed corporate boards, influenced regulatory policy, and guided the flows of global capital. Market chaos stopped being a threat. It became a lever. And the people with the longest lever arms were those who had been climbing that hierarchy for centuries. By the start of the 21st century, the system that protected the wealthy had grown so large, so interconnected, and so dependent on constant growth that its weaknesses began to show. Cracks appeared not because the rich were losing control, but because the machinery that insulated them required increasingly complex interventions to keep functioning. It was here behind closed doors, in regulatory chambers, at the crossroads of politics and finance, that the conflict between public risk and private protection became unmistakable. The dot-com crash was the first major signal. Millions of small investors poured into a technology market they barely understood, believing the new economy would erase old rules. When the bubble burst, retirement accounts collapsed, savings evaporated, and entire regions lost their economic base overnight. Yet the institutions that had underwritten the speculative frenzy, large banks, venture capital firms, and technology conglomerates, absorbed their losses and repositioned themselves almost immediately. They had hedged their exposure. They had diversified early. But the real moment of conflict arrived in 2008. The global financial crisis was not a simple downturn. It was a self-inflicted wound created by a system that could not afford to slow down. Mortgage-backed securities, synthetic derivatives, and structured debt products had grown so profitable that no major institution could resist them. The incentives were clear: private gains in good times, public consequences when the risks materialized. When the collapse came, ordinary people took the full impact. Homes were lost, jobs disappeared, small businesses closed, college funds were drained. The shock rippled through every level of society except the very top. Within months, the wealthiest institutions in the world received unprecedented support from the governments and central banks they had long funded, influenced, and helped design. Bailouts were framed as necessary to prevent total collapse. And in many ways, they were. But the deeper conflict was undeniable. The same institutions whose decisions caused the crisis were the ones most protected from its consequences. Losses were socialized, recovery was privatized, and while millions struggled to rebuild their lives, the ultra-rich used the moment to acquire assets at historic discounts. This was the turning point where confidence in the system began to shift. People saw, often for the first time, that the protection enjoyed by the wealthy was not accidental. It was structural, political, and deeply embedded in the way modern capitalism operated. Regulations tightened briefly, but they did not alter the fundamental dynamic. The machinery that had failed was repaired, polished, and restarted, generating even greater concentrations of wealth in the years that followed. The conflict deepened as global markets became more dependent on central banks. Throughout the 2010 seconds, interest rates remained historically low. Asset prices soared. Stock markets reached record highs. Billionaires multiplied. Yet wages stagnated, housing affordability declined, and the gap between asset owners and non-owners widened into a chasm. Every stimulus measure meant to stabilize the economy had the unintended consequence of inflating the value of the very assets the wealthy already controlled. Even the pandemic followed the same pattern. Central banks injected liquidity at unprecedented levels, and governments issued massive debt to keep the economy afloat. Their portfolios recovered faster than anyone expected. Meanwhile, millions lost livelihoods, savings, and long-term security. Here, the moral tension of the system became impossible to ignore. The institutions meant to safeguard the economy were forced to prioritize stability, even when that stability meant protecting those already safest. This is the corruption of modern finance. Not an illegal conspiracy, but a structural alignment between power and protection. A world where risk is shifted downward and rescue flows upward. A system where crises do not disrupt the hierarchy but reinforce it. And as these conflicts accumulated, one question grew louder in the public consciousness. Then what does risk even mean anymore and who is truly bearing it. By the time the 2020 seconds arrived, the global financial system resembled a machine that could no longer be turned off. Growth had become a requirement, not an outcome. Leverage was woven through every sector. Governments, corporations, households, and financial institutions all depended on one another in a web of obligations so dense that even minor disturbances risked chain reactions. The system had reached a point where stability required constant intervention, and intervention inevitably favored those with the most to lose. Yet beneath the surface, a quiet transformation was beginning. The same forces that had protected the wealthy for centuries were now creating pressures they could not fully control. The world was entering an era where the old forms of insulation, political influence, diversified assets, institutional relationships were still powerful, but increasingly strained by the scale of global risk. The first strain came from debt. Every major economy carried obligations that exceeded anything seen in modern history. Government debt soared past previous records. Corporate borrowing reached unprecedented levels. Even households, long expected to bear the weight quietly, the system relied on low interest rates to function, but low rates inflated asset prices to extremes. Any attempt to tighten policy sent shockwaves through markets, exposing just how dependent the entire structure had become. Central banks faced an impossible choice: allow inflation to rise unchecked, or tighten policy and risk destabilizing the very markets they had been supporting for over a decade. Either option revealed the fragility of a system built on decades of emergency measures. For the wealthy, the choice did not threaten their survival, it threatened the predictability of the environment they had relied on. Then came geopolitical uncertainty. Globalization, once the pillar of modern finance, began to fracture. Supply chains broke. Trade alliances weakened. Nations reconsidered the security of their financial dependencies. Capital could still move instantly, but political relationships no longer guaranteed safety. Once friendly nations imposed restrictions. Currencies fluctuated. Even government bonds, long considered the safest assets on earth, became subjects of debate. Wealthy investors adapted, of course. They diversified internationally, moved assets into private markets, and increased exposure to alternative stores of value. But the ease of the previous decades was gone. Protection required more complexity, more strategy, and more reliance on a system that itself was becoming less reliable. The final strain was social. As asset prices soared and wages stagnated, resentment grew. The public increasingly understood the pattern. Crises hurt them and enriched the few. Every bailout, every liquidity injection, every emergency facility seemed to widen the gap. The legitimacy of the system was eroding. Protests grew. Political movements shifted. Governments faced pressure to choose between stabilizing the market and responding to citizen anger. And each choice carried risks. The wealthy watched these developments with the same realism that had guided their class for centuries. They were not blind to the instability forming beneath them. Many began preparing for a different kind of future, one where financial protection was no longer guaranteed by the state, but by private measures. Private equity, private credit, private security, private enclaves. Wealth became more insulated, but also more isolated. This was the transformation. The shift from public systems designed to stabilize markets for everyone to private strategies designed to stabilize wealth for a select few. Governments continued to manage crises, but their tools were stretched thin. Markets still rewarded the wealthy, but with increasing volatility. The system did not collapse, but it changed. The architecture that once felt permanent now looked temporary, a framework kept alive by necessity rather than confidence. And while the ultra-rich still held their advantages, the landscape around them had become more unpredictable, more fragile, and more dependent on conditions that could no longer be guaranteed. What emerged from this transformation was not a new hierarchy, but a more exposed one. The wealthy were still protected, but the world that protected them was shifting in ways no one could fully control. By the early 21st century, the architecture of wealth had transformed into something both familiar and entirely new. The ultra-rich still possessed the protections their predecessors built: diversification, political proximity, institutional influence. But the world around them had shifted. The old assurances that once made financial storms predictable were fading, and in their place grew a system defined by uncertainty, complexity, and a widening gap between those who understood its mechanics and those who simply lived within them. The legacy of centuries of financial evolution was visible everywhere. Housing markets no longer reflected local economies but global pools of capital. Stock prices responded less to company performance and more to central bank policy. Debt, once a tool of states and empires, became an omnipresent feature of modern life, woven into student loans, mortgages, corporate structures, and government budgets. Risk was no longer something people encountered occasionally. Yet the distribution of that risk remained profoundly unequal. They worried about mortgage payments, medical bills, rising food prices, unstable wages, and the constant threat of economic disruption. Their financial lives were narrow and vulnerable, dependent on factors outside their control. A layoff, a recession, or a market correction could reshape their future instantly. For the ultra-rich, the equation was different. Their wealth allowed them to shift exposure away from themselves and into the broader system. They owned assets that appreciated when central banks intervened. They held capital that flowed toward opportunity when fear dominated the market. They operated through institutions with the ability to negotiate, restructure, or strategically absorb losses. Their survival did not depend on predicting chaos, but on understanding that chaos would not touch them in the same way. This disparity created a deeper philosophical question. Was the system ever designed to provide equal stability for everyone, or had stability always been a selective privilege? The evidence leaned toward the latter. From the earliest bondholders who financed kings, to the industrial magnates who shaped corporate governance, to the modern investors who strategically positioned themselves ahead of every downturn, the financial hierarchy had always been anchored by those with the most capital. Crises were not the exception, they were part of the cycle, and each cycle reinforced the structure that came before it. This is the true legacy of the system. Inequality is not a byproduct, it is built into the operating model. Today, even as markets evolve, the underlying dynamic remains intact. The ultra-rich continue to use downturns as points of entry rather than exit. They deploy capital into distressed assets, private markets, and emerging industries at moments when others are forced to retreat. They rely on global mobility, legal structures, and specialized knowledge to protect their positions. And they understand that every crash leaves behind people, businesses, and institutions that can be acquired, absorbed, or reorganized. But something else has also emerged, a growing awareness among the broader public. They recognize that the system responds to crises not with fairness, but with preservation of its foundations. They observe how governments move swiftly to stabilize markets, while responding slowly to personal hardship. They notice how policy decisions that reward asset ownership disproportionately benefit those already in the upper layers of the financial hierarchy. This awareness is not a revolution, but it is a shift. And that shift signals the beginning of a new era, one where the narrative surrounding market chaos is no longer accepted at face value. People question the fairness of recoveries that favor investors over workers. They debate whether markets truly reflect economic reality or function as engines of accumulation for those with the right tools. They ask why resilience is sold as an individual responsibility when the wealthy rely on systemic protections. The future remains uncertain. The system may continue to adapt, reinforcing the advantages of those at the top, or it may face pressures from political shifts, demographic changes, technological disruptions, or public demand that force new forms of accountability. Transformation is possible, but not guaranteed. What is clear, however, is that the story of wealth and crisis is not ending. It is repeating, evolving, reshaping itself with every cycle, and the lesson carried across centuries remains unchanged. The ultra-rich survive not because they avoid risk, but because they exist in a structure where risk is absorbed by others. Until that structure changes, the pattern will continue. Thank you for watching this video. Click here to watch another video that might interest you.